Alright, so in this first lesson, I've put together a compilation of aspects that summarize what took me years and years to assimilate, to interiorize, and to imprint in my mind. This first lesson, therefore, is going to constitute the building block, if you will, that will always be very helpful for you to refer back to when being reminded of what it really takes to be a consistently profitable trader. One of the adages that I always apply and that I remind myself is that you cannot go really heavy in this game if you want to be all out and gain freedom. You have to give it all. You have to put maximum effort to reap the benefits that this industry provides. This lesson, therefore, is going to be a reality check for many of you of how many departments you must take care of in order to, at the end of the day, you have to avoid the common pitfalls, and these pitfalls have been well summarized in this lesson. So let's tackle each and every one of those of these aspects and be reminded that by you working on these points that will be discussed, you will be definitely giving yourself the best chance possible to make it at this game. So the first aspect why traders fail is because they have no preparation. They go through no preparation before every single trading day. And what I mean here is that getting into the right state of mind before day trading the markets is absolutely essential. And I have to say that that's not how the majority of traders approach the markets. You must really make sure that your prep is an integral part of your trading. This is where, as I reiterate many times over as part of my daily videos, half the victory is already achieved. During your prep, that's the time when you select the markets you want to be focusing on, and you just really cannot be doing that when the markets are moving, and absolute and utter concentration must be required in your trading time frame. Remember that your performance in the strategy that I teach is going to be hinging on the ability to spot and exploit low time frame setups by first identifying what's tradable and what is not tradable and we should ditch for that day. And this is going to be in line with the rules-based methodology. And you cannot pretend that you're going to be ready to take this approach if you're just going to be sitting at your desk 5 or 10 minutes ahead of the session open, randomly checking the charts to spot any potential setups with no routine at all. And at the end of the day, really the process must be mechanical and boring. And remember this last adjective, as there is a strong correlation between seeking excitement that tends to lead to poor results in the market versus setting up a routine that might actually feel like it's boring. It's a boring process at times, yet you're going to be achieving, and take my word for it, much better results. So when I trade, I always come, for example, to my desk with a buffer of 30 minutes ahead of it. And first step before anything else is to always read my trading plan where I stipulate all the actions that I must be performing in detail. I disconnect my phone and other potential distractions. I'm analyzing religiously each and every chart to validate what's on my watch list. I want to obviously understand the type of conditions that I'm facing for the day. Is there any high impact news that is going to be influencing the currencies that I'm interested on? And this preparation is going to set me up to tackle the markets at what I consider to be an optimal state to maintain focus. Now, the second aspect why traders fail is because, plain and simple, they just don't have a trading plan. And just to make an analogy, when we drive a car on the road, we must constantly abide by traffic rules in order to harmonize certain behaviors for every situation that we are faced in, right? So I can think of, for example, stopping at a red traffic light, or slowing down when at a pedestrian crossing, or use snow chains in certain weather conditions, etc. These are very strict rules that we have to abide by. Now, fortunately for our safety, these harmonizations of directives, it's done in a seamless manner, because there is when driving, there's a central entity that determines such rules. Now, when trading, unlike driving, there are no rules other than the ones that we set for ourselves, and it can be very, very tricky. What this means is that without a frame of reference that controls our actions, everything can become very chaotic and our behavior largely inconsistent. And that's why, as part of my daily routine before I trade the markets, I've enforced for many years a rule to read through a compressed version of my trading plan, which includes things like entry rules, money and trade management, nuances that will be applied, etc. And it is only 1 page to 1.5 page long, which makes it much easier to read over and over every single day during my prep. If it was, for example, 3 or 4 pages long, sooner or later it would feel just too heavy going through this trading plan and reading it every single day. So here's where another mistake lies, which is, which has to do with a trader's inability to gradually synthesize and shift from a complex trading plan with an excessive number of rules to a shorter and more concise one that is going to be still going to be comprehensive and relevant, but it's just 1-page document where only what really matters is written as part of this trading plan. Okay, so until you write and read your trading plan every single day and make a conscious effort to respect what's written, no matter what, you will not be true to yourself, and you will be doing yourself a disservice. And let me tell you that one of the key components to be successful in any endeavor is to align with your authenticity, which comes very high on the list of attributes that one must possess to accomplish high performance. And reading this trading plan every single day, it's proven to yield fantastic results for me. So hopefully you apply that lesson too. Now, the third aspect why traders fail is what I call an eternal system hopping. And I have to say that there is a very fine line that separates a gradual fine-tuning of one's strategy without really altering its core edge, and the risk of over-refinement, which sooner or later leads to the dreadful path we've probably all faced, okay, which is changing the strategy. Now, so if you're moving away from the strategy that you were using in the first place, you just have to be aware of it, okay? Whenever that happens, what is important is not really as much that you change your strategy, but ask yourself why you keep repeating this cycle over and over and over again. Getting to the bottom of this question is going to by far yield the best revelations. What led you to decide the former system is no longer valid, assuming you back-tested it and it proved profitable. It proved that it had a positive expectancy. Were your expectations to get positive results unrealistic perhaps? Did you lose faith after experiencing a bad losing streak, which almost everyone, if not everyone, goes through? Did you feel like you couldn't adapt to the strategy based on your personality as a trader? Coming up with a congruent answer to these questions will by far reveal will give you the best revelations, as I said, and will give you the actual driving force leading to make these decisions. Will shed that light. And let me tell you that for the most part, it has to do with understanding first and foremost, how do you enjoy trading? How do you have fun trading? What ticks for you that you feel resonates with who you are as a trader? Your true identity, identifying your profile as a trader. There's nothing wrong with changing the way you trade the markets a few times during your journey as a trader. Just realize that sooner or later, you cannot be stuck in this vicious cycle of constantly jumping around how you approach the markets forever. That's why really understanding yourself comes at the top of the list. Okay, so that's the third aspect. Another aspect, the fourth one, is not journaling your trades. And I can tell you from experience that if you are not tapping into the insights that a trading journal provides, the extent in which you can improve as a trader by identifying what you're doing well and what are the trading mistakes that you must gradually remove out of the equation, is going to be quite limiting in nature, I have to say. In any endeavor that involves entering a highly competitive field, be it football, basketball, golf, whatever sport you like, the power of constantly being engaged in a feedback loop cannot be sufficiently overstated. The repetition of common mistakes is a very costly business that you must address, which is only going to be possible if you work with the tools that allow you to, and this is very important, to quantify how much of an impact your mistakes are having in your bottom line results. Similarly, wouldn't you find it, like for example, tremendously valuable to identify under what set of conditions you tend to make the most returns? How about, for example, insights such as the underutilization of resources that allow you to perhaps shorten the stop loss size to aim for higher risk rewards? At the end of the day, a trading journal is a filtering mechanism that provides the necessary insights on what's working as part of your strategy and what isn't, and what can be improved, and while identifying also behavioral patterns that you must remove and reinforce altogether. So you must continue to constantly tilt the balance towards actions that are going to be conducive in eliminating unnecessary losses, while at the same time working on those that bring the most reward. And that's what a trading journal does for you, okay? Which is, a trading journal is at the end of the day an excellent tool that is going to help you to become, it's like a mirror that you refer to. It reveals a lot of information, and it keeps you committed, and that's going to be, the quantity of data that you can get is tremendous. Now, another mistake has to do with trading around high impact news. Now, in hindsight, I know it really feels such an obvious mistake at times, and one that really originates, in my personal opinion, from either lack of concentration or lack of preparation, or simply approaching trading from a gambling mindset, which is not really, it's not going to take you very far in an arena where it's all about exploiting your edge, the one that you've backtested. So even if it sounds as though it is intuitively easy to avoid the mistake of trading high impact news, I've been personally the victim of trading around high impact news several times in the past. And it's not precisely the best times, and you don't achieve the best outcomes. Fortunately, the moment that I understood in my case that the reason I was behaving in such a irresponsible manner had to do with my need to get a high stimulant in a way while trading, which is probably why many still risk capital in hopes of a runner out of an economic release. When I realized, then things started to change around. So you really also need to realize that such an approach, trading high impact news, will more often than not result in unnecessary losses that could be avoided if you were just to simply stay away from this news. Just let the dust settle first. There's just too many factors against taking this leap of faith approach and just trading the news. Firstly, why do you think brokers will widen the spreads? Because there is a sudden removal of most of the liquidity available in the markets right ahead of a major data release. Now, why do you think that happens? The reason is, as I said, because the majority of market participants with an intent to make money are not going to be in the business of playing the lottery, which is a high impact. It really is what a high impact economic release is. And besides, right ahead of an economic event, algorithm activity, those that are going to be deep in the weeds involved in the algorithm activity are going to be running liquidity in both sides many times, taking out the stops. And, that's obviously a potential a potential danger as well that you don't want to be exposed to. So I do have rules to be away from markets that are going to show high impact news in the following hours. So that's also an important aspect. Now, another reason why traders fail is because they duplicate risk. And this one really falls under the same category as trading high impact news, in my opinion. As I think the main problem here has to do with either complacency or lack of responsibility to really properly define your rules. So in hindsight, it probably sounds like something that may be easy to avoid, but whenever you are in the heat of the moment and adrenaline-driven stimulus takes over, these mistakes can easily happen. And let's just say, for example, that the US dollar is sold across the board and you spot what in your view looks like two trades on the Aussie US dollar and the New Zealand US dollar. Your greed under this situation may take over, and before you know it, you enter a position in both pairs in the expectation that you could be making twice as much, leaving the responsible approach of thought of how much you're risking on the back burner. And and behold, before you know it, you find yourself underwater in both positions as the US dollar sell side continuation doesn't really play out. And as you should know by now, the Aussie and US dollar and New Zealand against the US dollar, they tend to be very highly correlated. So you must be aware of duplicating the risk. You could trade both positions as long as that's part of your plan of engagement, which may include whenever you are faced with this type of situation, you split the risk between the two pairs, half each or 2/3 each, whatever, okay? Now, another aspect that I want to talk about is focusing on the money versus the process, okay? It's a big mistake that traders make. If you divorce from the money aspect and just focus on making good trades, you'll project your focus and attention where it really matters and not, be distracted by the mundane things on a day-to-day basis. Okay, don't be a slave to your P&L every single day. That's not what trading is about. Look at the big picture. I personally make an assessment of how well or poorly I perform on a quarterly time horizon, okay? And that takes the pressure completely off, okay? So please don't let the market consume you by thinking about just the money. It can drain you if you just get obsessed with the money factor, okay, which can take you down the path of making you a secluded person, a loner, okay? So don't be wrapped up on every tick. The market doesn't give a rat's ass. The market is a probabilistic mechanism and is not going anywhere. It will be available for you tomorrow again, that's for sure, okay? So enjoy a healthy life, spend time with your friends, with your family, have a life which starts by having a process, a routine that fits into your day. It can't just be about the markets all the time, nor about thinking obsessively about the money, okay? Now, another aspect why traders fail is using technical tools of lagging nature. And a theory that has always resonated with me is to stay away from the majority of NT4 free indicators, okay? In my view, it's all about levels where liquidity resides, price action, and in between a lot of meta games or the psychology behind the game. Okay, in brinkmanship terms, meta games is the understanding the emotions of other participants. So there's definitely a slight degree of discretion that can be applied, as some of the so-called lagging indicators can act as a complement to one's strategy. But for the most part, the over-reliance of the retail type trader on these indicators is one of the main reasons also why it is so hard to be a consistently profitable trader in the market. It is not impossible, as some traders may replace the efficiency of lagging indicators with some excellent risk management so that they end up cutting losses short and letting winners run. But nonetheless, MT4 default indicators will mainly make calculations that are based on past data as opposed to using using tools derived from real-time activity, which is why I tend to emphasize that the blending of structures, momentum, volatility, price action, entry patterns, it's what really stands for me, what stands out, as it opens really the doors to a major boost in your real-time statistical skills. Now, another aspect why traders fail is lack of focus, plain and simple. You must be concentrated on the now. The next trade is the most important trade in the world. The reality, however, is that we are inundated with distractions non-stop, and unless we cut them out, the external noises, and we really properly train our mind, these are going to consume us and they're going to screw us. Okay, so the solution that I found personally, internal dialogue as a concentration enhancer, is very powerful, and traders really underestimate it. In a nutshell, like for example, the moment that one understands and acts as the commentator of their own trades real time internally, for example, a whole new universe of awareness and presence in the moment really transpires. So the level of engagement and concentration really goes through the roof and goes up, as I said, goes up considerably. So the art of controlling your emotions, gaining clarity when trading, reinforcing an idea, strengthening one's profile starts from being true to ourselves. Hence, having a constant self-interaction, internal dialogue is immensely valuable, keeps you focused, keeps you in the flow. If you start practicing this dialogue every single day, you will gradually see the speed and quality of your decisions increase as your distractions and your poor judgments decrease, okay? So, really, isn't that the point of running a trading journal? The advantage of an inner dialogue, therefore, in many ways, is that it acts as a form of preemptive circuit breaker, allowing us to anticipate unnecessary mistakes that would otherwise get registered in our journal, but they are first registered in our mind by having this internal dialogue, and it's huge. Okay, the lack of concentration when trading the markets intraday does originate really from multiple sources. It can be social media platforms, the likes of Facebook or Twitter. You engage in these platforms while trading, your chat on Discord running at the time of a trade. You could do so, but this multitasking is much more challenging. Attending calls or messages during your trading, whatever activity it is that you engage on that has the potential to take your focus away from the screen, that's unacceptable. It's an acceptable behavior, and if you're serious about your trading, I will confess that every now and then, even though I still fall victim of my own distractions because nobody's perfect, you really need to give yourself the best chance possible, okay? So, it's going to be a gradual improvement. You will not just go from all distractions in the world to zero distractions. It takes at times years. But to me, even if the markets go quiet, for example, I nowadays know that nothing must overlay the priority I place to my trading. Therefore, even if the markets stagnates, I can always use this time to read a book, refill my drinks that I'm, always having something to hydrate, stretch my legs, etc. This type of smart approach, when done consistently enough, would reduce whatever urge I have to engage in any sort of distractions while at my trading desk, which in turn I know serves my goals as a trader. And that's precisely what your actions should be aimed towards, leading by example. Okay, so remember this, being in the flow won't happen unless you are previously in a focused state. Flow follows focus. The aspect why traders fail is risk aversion, and this is a big one, as society in general doesn't teach you how to lose. We've been conditioned to always aim for the wins. It's just really human nature. Therefore, a common pattern is that you are still not entering a trade when your system, your strategy gives you a signal. You get paralyzed after a series of losses, or your judgment to call a trade is somehow impaired by the memory of that latest loss. So if that happens, then a component of fear is affecting the way that you trade, and that must be really, really addressed, okay? Because of the way our brains have been wired over history, we tend to seek security over risk. We tend to magnify the number of negative thoughts over positive ones. That's just the way it is, unless obviously you train to think and act differently to avoid the constant activation of your, what we call, primitive portion of the brain. Fear can take many forms in trading. It can really originate from the anticipation of thinking that you're going to be losing money, for example, of disappointing someone if you don't perform as expected or as they are expecting, trading too large a size, or fear of not being good enough, or etc. So firstly, you really need to pinpoint what exactly you're afraid of and how bad that's affecting your bottom line results. Remember, trading journal. The practice of any activity that helps to calm and relax your brain, such as, for example, deep breathing, meditation, coupled with internal dialogue, remember what I mentioned in the previous point, will make a tremendous difference in your ability to detect when an element of fear is hindering your trading. In my case, I was able to build new neural pathways in my brain through the repetition of a direct affirmation that I wrote down 2 times per day for over a year back in 2015. And it read, "It is like me to trade the markets without fear or tension. By trading without fear or tensions, I allow myself to participate in a statistically backed winning strategy." What this does is to reinforce your self-image about who you really are when trading the markets, okay? So besides that, I've worked for some time now to identify and channel the negative connotations of fear as an energy that it can permute to help me, okay? That was done a long time ago and I continue to do so today. So how do I achieve this? For example, by transforming this energy into a vehicle that will help us push beyond our boundaries, working extra hard, building more skills, which leads us to fear of inaction far exceeding the fear of failure, hence taking more action to avoid inaction. And if you are certain that you don't want to be a victim of your own weaknesses, fear, or confusions, the only way forward is to get your act together and be ready to do whatever it takes to live a bolder life. I've always loved the quote in trading that fortune favors the bold, which in the case of those suffering from fear, it's a great reminder that in life, risk is an inherited part of living, especially when trading. At the end of the day, really it comes down to embracing a loss and seeing it as just an event that takes you closer to the next win. Release it, let it go, spit it out, or it will collude you, okay? So another aspect the why traders are failing is no proven statistical edge. What I mean by that is that, and really, this particular one orbits around backtesting and forward testing at the core. If your aim is to build confidence in a specific strategy that will act as your trigger mechanism to enter the market, you should definitely go through a rigorous process of backtesting it to determine if it has proven to be a profitable strategy over a large enough sample of trades, what we call positive expectancy. The longer the in sample, the more robust your statistical edge can be, which leads to increased conviction upon its expectancy, as I said. By backtesting a strategy, you also avoid the common pitfall of letting the short-term results determine your level of commitment towards your strategy. Remember, eternal system hopping. You will sooner or later face a rough patch of losing streaks, which is where it will test your conviction towards the strategy that you deploy. Back in the days, I made countless mistakes of letting these short-term results justify that it was time for me to seek out yet another way of trading with the somehow elusive thinking that losing streaks could be avoided. Now, the way I overcame this seemingly vicious cycle, if you will, with no end in sight for many aspiring traders, involved the combination of, first of all, finding a strategy that resonates with one's personality and running results simulations as far back as I possibly could with a true sense of authenticity and honesty with myself. After I completed years of obsessive testing, the next phase was to trade the strategy live with minimal capital on the line, starting from as little as 0.25% and only increase the risk per month if the results had proven profitable over this period. Also, as a word of advice, I wouldn't fall victim, okay? So don't fall victim of on the over-reliance on automated systems that are being sold online for a few $100s. There is a reason why people would be advertising these expert advisors, these algorithms. They tend to perform well in certain market conditions, doing back testing, only to blow up when conditions in the market change. Okay, and there's a big industry on selling these EAs, so word of caution there. Lastly, don't try to be a hero by not using stop losses, which is the cost of conducting business at the end of the day, and stay away from an over-reliance on money management that includes ideas like the same pair hedges, basket grids, averaging down recklessly, martingale variance, etc. These strategies, in my own personal opinion, are all inherently very risky. I could be wrong, but that's my opinion at least. Another aspect why traders fail. Failure to have a probabilistic mindset, a big one, this subject. Now, in the book Trading in the Zone by Mark Douglas, which I wholeheartedly recommend to anyone who is serious about trading, Mark mentions that a probabilistic mindset pertaining to trading consists of 5 fundamental truths. And the first one is that anything can happen in the markets. Second, you don't need to know what's going to happen next in order to make money. The third one, there is a random distribution between wins and losses for any given set of variables that define an edge. The fourth one, an edge is nothing more than an indication of a higher probability of one thing happening over another, nothing else. And the fifth one, as Mark defines it, every moment in the market is unique, right? So the right psychological mindset in trading is absolutely vital. If a trader is capable of being detached from its survival instinct mindset to instead truly ingrain these principles from Mark Douglas, you will be trading from an optimal state, as your expectations will always be in line with the psychological realities of the market environment, removing market information as painful or threatening, which is huge. Okay. All right. Another aspect, failure to let the profits run. A big one, once again. The action of wanting to guarantee the taking of profits ahead of a predetermined target over thousands and thousands of trades in your career, I personally found it to be quite detrimental in optimizing your trading results. Remember this, okay? I've repeatedly stated that your trading account at the end of the day is a reflection of where you are in your development as a trader. When it comes to taking profits, an important trait that is manifested is your ability to be patient for your projected target to be hit. In retrospect, I know that it sounds like something that you should be doing more often if you fall victim of this mistake, but the hasty action of taking profits before you let the market hit your ultimate profit targets really carries also a psychological benefit if you think about it, because it really reinforces your self-belief that you just simply let the market forces dictate the outcome of the trade without you having to constantly be intervening to alter the results. You've already defined your stop loss, your target, 3 to 1, 4 to 1, 5 to 1, period. Okay, so that said, there's nothing wrong in adjusting your target a few pips as you realize that you just placed the profit line right after a round number that may be acting as a barrier. That's just fine. What sets out the wrong habit is to be monitoring the trade right on the spot live, and just as the trade moves in the direction of your target, you cut the trade short significantly as the fear kicks in, the fear of your trade turning against you for a break even kind of grows, right? Because you're just getting closer to that ultimate target, that good feeling kind of sensation. So that action what I was mentioning about cutting short your profit is, at the end of the day, is an admission from your side that you haven't really accepted the market to determine the outcome. And this tinkering of your positions can be an endless rabbit hole if you don't set the right foundation and habits to let the profits run to your ultimate target or to wherever the market wants to go. The key here is to really accept the randomness and unpredictability of each single outcome while having blind trust, one that is supported through your back testing and forward testing, that over a large sample of trades, these targets will be reached, and that by you altering the results, you are also disrupting the potential maximization of your trading results. So the more you detach yourself from the outcome of your next trade as the make or break in your level of confidence, the more relaxed and easier you will find it to accept as a random event where the price will be headed. Yet each time your target is hit, you will gain a deeper and deeper sense of satisfaction as you remain true to yourself and true to your strategy. Right, so one more aspect why traders are failing is they don't cut losses short, I should say. So the moment that you start going down this rabbit hole of not placing a stop loss, hence defining your risk per trade, to instead apply some type of grid system or even a martingale strategy by which you multiply your risk after each loss, that's the clearest recipe for disaster in the majority of traders. It will happen sooner or later. You will blow your account. And I won't say for all, as I'm sure there are some accomplished traders able to exploit strategies like martingale with some wizardry tricks, whatever it is that they do. However, for the vast majority of retail traders, not setting a stop loss or taking too big of a hit every time you lose versus what you make when you put on a winner is unacceptable. You are plain and simple not placing the mathematical odds in your favor to have a positive expectancy unless you're able to adjust your winning percentage to the degree necessary to offset your large losses. If you really would like to find out what combination of winning percentage and risk reward you need to make sure that your account runs, and this is what you should be aiming for, a 0% chance of blowing up, I recommend checking any risk of ruin table which are available on the internet, which I will touch on in depth through this course, because that will reveal a lot of information. The moment that I came to understand the math behind trading and the combination I had to respect, that's when I could safely state that I would no longer treat this business without the mathematically oriented rigor that is required to generate positive expectations. Now, another aspect why traders fail: not letting the market come to you. Patience. Traders that have fallen into the trap of trading out of impulsivity due to boredom or by the selection of suboptimal levels really abound out there. There are many that do this, and I find that the need of trading, the trading action really reflects trading as an adrenaline booster, which is the worst possible outcome. The more I thought about it, the more I realized that part of the reason has to do because traders really tend to find excitement and acceleration from trading. And if you are the type of trader that associates trading with a source of adrenaline by observing your account go up or go down, that's another trait that you must get rid of at the earliest possible time. Trading should be seen as an exercise of self-control, constrained emotions, patience, authenticity, commitment, which at the end of the day will result in letting the markets dictate when a setup in line with your edge is in the making, as opposed to forcing it. Do not force feed them. The more you can detach trading as a source of excitement to instead perceive it as a simple intellectual activity that provides, as a byproduct of your consistent actions, potential unlimited rewards, the easier it will become for any trader to apply the necessary patience. And if along the way you find that you are left waiting on the sidelines without any trigger, longer than you can bear, you should then start considering slight adjustments such as adding markets or lower time frame to trade, so that you can hopefully find a remedy, that sweet spot, to an easily addressable issue before it leads to over trading, okay, and forcing trades. Goes without saying that people making mistakes in this particular department are yet to find themselves who they really are as traders, matching style with personality. Otherwise, they wouldn't be forcing trades. Okay. Now, another aspect why traders fail is because they set unrealistic expectations. Now, the passing thought of making millions of dollars in trading crosses, I believe, almost everyone's mind, okay? And let me tell you that that's a double-edged sword. While you should be ambitious and have dreams, the more disconnect that exists between your current state, where you are in your trading development, and where you want to be, the more disparity exists in your expectations. The best way personally that I found to reconcile this apparent clash of reality versus goals is to not set any expectations, but instead focus all the resources in the art of following a process to the best of your ability. And for that, a book that was pivotal to my change of mentality is The Power of Habit by Charles Duhigg. The more you respect your process while gradually detaching from monetary goals, the more you can concentrate on the task at hand without being influenced by external factors. What eventually you realize is that building an account really becomes a byproduct of your consistent actions and routines. Okay, very much relatable to what I mentioned about the process versus the money. And by dedicating all your energy to all the setups necessary to perform the process flawlessly without trying to alter what's uncontrollable and randomly dictated, such as the distribution of trading outcomes, you're giving yourself the absolute best chance to reach distant dreams at present, one brick at a time. All right? Now, another aspect, and I know this one is going to be a little bit controversial, but it's traders don't do enough or don't do at all physical exercise. Working out to me has undeniably huge benefits of stimulating your brain. If one exercises systematically the parts of your brain responsible for improved memory retention, intellectual capabilities, and thinking really activates to a whole new level. And additionally, sweating it out releases specific chemicals inside your brain, which leads to improved sleeping patterns, mood and stress, and that all has a massive benefit. Now, regular exercise also increases the level of endorphins in your blood, and therefore it reinforces the good habits of happiness, calmness, and confidence, all critical when trading the markets. And when these attributes improve, so does the ability to control your emotions, which makes you less impulsive to trade. Now, on top of that, being fitter means that you build a greater immune system as a defense wall against disease, which means your improved health leads to fewer days at risk of being sick, feeling sluggish, whatever. What's more, by working out regularly, you become more disciplined and organized in the task at hand, which translates into how organized and committed you are in other areas of your life, like trading. In my own case, probably most of you know, I do CrossFit 5 days a week from Monday to Friday, sometimes even Saturdays as a bonus. And not only I love how it's helping me to stimulate my brain and take a much needed cognitive break outside the screens, but it's a great personal challenge also, knowing that every single day I look to push myself into new limits in terms of weightlifting, movement patterns, etc. And you could include any sport, really. I mean, yoga, meditation, basketball, football, whatever it is, as long as you get yourself moving. I find all these sports very fitting. And to sum up, doing regular exercise allows you to enter the optimal state of mind for consistent peak performance. Now the next one, and that is kind of optional, but meditation. The power of meditation, I think, cannot be sufficiently overstated. And it acts as a vehicle that can help to rewire brain for success, build emotional IQ, and other elements, all essential for trading success, such as enhance the ability to be present in the moment, develop improved pattern recognition skills, retention of memory, you name it. A major challenge of mine before meditation used to be the activation of my fight or flight response to certain tense situations when trading, even if I theoretically knew as an aspiring professional trader that my attitude should be to stay calm, collected, relaxed, and cool. But the more I've meditated by just spending 10 minutes a day, the more I've contributed for my brain to also stay in a state of internal peace and happiness, while I feel more in charge of my emotions and internal dialogue. I also feel that this has translated in my determination to make tough decisions in life in general, and the practice I've performed over many years, if you wonder, it's called shamatha, and I tend to do it in my mornings and ahead of trading, as well as a practice really aimed to strengthen the mind's stability and to counterbalance the symptoms of an agitated mind. All right, shamatha meditation, which is mindfulness of concentration, is the foundation of Buddhist practice. And trading is a very mental game. It's played in your mind most of all. That's why you must know who you are, knowing how to play your game and play within yourself. Meditation really is a great venue to sharpen your axe, to sharpen your mind. Now, another aspect why traders fail: failure to have a growth mindset. If you think that by making money for a certain period of time automatically means to stop improving your craft, for example, not put enough time to constantly be improving your actions and let the focus slip away, let me tell you that you're not doing all the things that will keep you in a consistent path. Your skill level has to continuously be refined. And I fortunately always had a high ethical approach to trading, never sleeping in the laurels. Just because you get to a level of trading that seems effortlessly, it doesn't really mean that you stop. You need to develop a growth mentality, one that is going to perceive brighter and better goals that can be achieved down the road. One that perceives going through a hardship as just an obstacle that tomorrow or next week or next month or next year could be addressed. So this mindset mentality is reflected in every area of your trading, in your desire to improve and engineer your trading plan with constant observations to keep the edge, in your motivation to tackle new learnings, new goals, add another book to your collection, rewatch hours of content that are going to be relevant to your strategy, etc. You name it. You are engaged in small hacks as part of a big picture that's going to help you get from where you are to where you want to be. All right. So last but not least is failure to take care of the red. And this is a term that I came up with to encapsulate resilience, experience, environment, discipline, and dedication. And no surprise, it reads as the color red, but with double E and double D, as I wanted to somehow relate to a red flag or something that warns you, hey, there's danger ahead, something that it's relatable to negative, if not possession of it. So if you fall short of any of these departments, the chances are that you may be trading suboptimally. And let me now break it all down. Let's first touch on resilience, which I essentially see as the inability to bounce back after a string of losses is encountered. Now, in my opinion, this has to do with lack of self-belief, which comes from failing to gain conviction through a period of backtesting of your strategy in all types of environments. Because let me tell you, if you go through this type of rigorous backtesting, your conviction is going to go through the roof. Resilient traders can see that these adversities of having a string of losses are going to be short-lived, and they have a goal which will enable them to overcome obstacles and become emotionally stronger and more capable traders. okay? So remember this one. Next one is experience. And while you may not like what I'm about to say, better be told how it is, okay, from the very get-go. Unless you accumulate experience through your own journey as a trader, there will be gaps in your knowledge that still must be assimilated, and that unfortunately only comes by deliberate practice and time. It's not enough just having a course and going through it, okay? So you cannot just be told the theory and by magic perfect the game in no time just because you understand things on paper. You have to be a hustler. You have to put in the time to practice. The third one is the environment, and in particular, making sure that you are moving away from a toxic one, which is essentially letting outside noise affect your decision making via following trading signal providers, chat rooms with negatively charged comments, an unstable relationship, the wrong type of friends, you name it, and you get the gist. You must be able to create the type of conditions outside and during your trading that are going to be conducive to perform physically and emotionally at your optimal level. Now, the next one, as part of the red term, is discipline. And it's not enough having written a trading plan. The next stage where you'll prove to yourself how disciplined you are is to be able to obey the rules, to stick by the rules that you've defined by imprinting this code of behavior, no matter what. Highly disciplined traders do not deviate from any of the rules stated in their trading plan. And lastly, dedication. Dedication is all about, at the end of the day, let me first say this, at the end of the day, it's a byproduct of having, a passion for what you're doing. And if trading is something that ticks for you because of the personal challenges that it represents to grow as an individual and know yourself much better, it's going to always be much easier to develop the type of quality as an individual to being dedicated or committed to a task or purpose, okay? So if you are not passionate, it will also become very easy for you to look for another venue when the going gets tough. And finally, as closing note, I just want to say that I hope that this summary can provide a framework of reference for the aspiring trader that is going to go through this course, or for the experienced ones that are going to go through this course, to refer back to as a collection of tips that can make you save both time and money trading the markets. It's always going to be easier to look back in hindsight and think how I wish I knew all these pitfalls before I started trading, but let me tell you that as part of your own journey, it really pays off to experience these mistakes firsthand with low capital, etc., and grow from there. And so hopefully you've already gone through many of them, and this is just a reinforcement. And until you tested it by yourself, I believe that it is just human nature not to treat these departments, these aspects, why traders fail, with the relevance and respect that they deserve. So if as part of your progress as a trader, you can come to introspectively realize through your own imperfections how toxic these mistakes can be, that's a lot that you already won to then start polishing things off, all right?